Welcome. This is Ralph Bivins with the Ralph Bivins Project. We're here today to talk about investment, and we're lucky to have some of the people who are experts in investment. They've been doing this for quite a few decades, and we're Al Hartman, CEO of the Hartman family of non-traded REITs, the Hartman Income REIT management and things. He has a lot of funds that are operating under the Hartman umbrella that invest in properties in Texas and everything. And with him is David Wheeler, who's also with the same firm, Chief Investment Officer. So they have done their shares of deals, and this is time to be thinking about deals. We're in this this transition phase and in a phase with the economy that we don't know exactly what's going to happen, but we feel like it's going to be big. Anyway, but Al, you founded this company, in the early '80s, and tell me how you got started. How did you get started?
Well, Ralph, I moved here originally from Indiana when I was 29, but I was buying properties in Indiana, residential properties. I'd been in the home improvement business and raising money and improving homes and selling home improvement projects. And I was making money, and I took the money that I was making, the profits from that, and started buying residential properties in Indiana. And I had about 25 or 26, 27 residential units altogether. And then I sold those in the early 80s. I sold everything I had there. I did that for 2 or 3 years, sold everything I had for a profit. Everything there was value add. I increased the value, sold it for a profit. And then I looked for greener pastures, Ralph. And so I looked all over the country, did research all over the country, and noticed Houston stood out among all the cities. Houston was the golden buckle on the Sun Belt back in the day, and back in the early 80s, it was booming. And so I moved to Houston, and I was back in about 1981, moved to Houston, about 29 years old. And I started raising money locally to buy properties. In addition to my money, I put started raising money to buy properties, and bought the first property, I think, closed it in 83. It was near the medical center, and then ended up, that did extremely well, and ended up buying about 100 other properties after that and continuing to raise capital. But what was interesting, Ralph, what was really interesting about that is that the timing, when I bought the first property, the economy had peaked in 81, November of 81. The price of oil hit $40 a barrel back then, which was really, really high back then. A year later, it had dropped down to, I think, about $8 a barrel. So Houston, it took a while for Houston to realize the impact of that. And so, but by 1983 and 84 and 85, property values were declining, and property values declined all the way through 1990. Mm-hmm. There's like 10 years of decline. It was worse than the Great Depression. Actually, we were in a sense, the Great Depression here in Houston because of the 10-year down cycle. And so during that 10-year period of time, I was able to continue to buy properties. I was continuing to raise money. I bought about 20 properties in a row that were actually foreclosures during that period of time. And so we really...
The 20?
Say it again?
The 20 foreclosures, were those office buildings or what?
Those were primarily retail and industrial. That's what I was buying at the time. Retail industrial we still buy retail industrial. And but at a certain point in time, we started morphing. In the 90s, we started morphing a little bit more into office because we saw there was a little bit more opportunity with office. And even today, Ralph, the markets, and industrial, you can buy industrial for 4 cap or 4.5 or 3.5. I've seen some 3.5 cap, very low cap rates. Retail maybe is a little bit better. You can get some 6.5, maybe 7 if you're lucky. And so we're still trying to buy some retail. Industrial, we're priced out of the market, but office buildings, you can buy with a potential cap rate of 10, 11, 12. We see some for 15. We see some that are once in a decade, Ralph. We haven't seen these buys in 10 years, where you can get a 15% yield on an all cash basis when the property gets fully stabilized. And so those are the kind of buys we're seeing in the marketplace with office right now, especially in Houston.
So it's a pretty good time to jump on some office deals. If you have some spare change, let's get them.
We really like Houston, and we really like office right now because of the upside.
Yeah, I've noticed in the energy corridor just lately, several buildings have been selling, and one building that was completed 7 years ago that never had opened. It just been never had a tenant. It's been in mothballs for 7 years, and they're starting to market that again, finishing it off, and ready to go back. So I think the energy corridor, although oil is looking good in a lot of ways, it does seem like oil's over $100 a barrel, and even though the energy corridor office market's been soft, it might be a time to take a strong look at it.
Yeah, absolutely, Ralph. No question about it. As a matter of fact, we bought a bunch of properties there in 2019 along the energy corridor and in Park 10 in 2019, before the price of oil dropped, before it went down, and before we had the economy drop. The economy really dropped because of COVID. And so in any event, we went through a very difficult time over the last, especially 2020 was a very difficult time. 21 was recovery. We hit bottom at the end of 2020, and 21 was a very nice recovery, and now we continue to recover. But going back to the energy corridor in Park 10, these half dozen properties we bought there in that area have done exceedingly well. I mean, they've done so good that it's just hard to explain. For example, we bought a property. One property was about 35% occupied. It's now 90%. Another property was 40% occupied. It's now over 90%. We bought one building in the energy corridor that actually was so distressed. It was 40% occupied. It had the air conditioning system sitting on a truck outside, with it being vented into the property from outside. I mean, that's how bad it was. The AC system was totally shot, and they were supporting it from a remote system outside the building. So that was very distressed, as you can imagine. So we took that over, put a new unit, a new air conditioning system in there, made some other improvements, and got some spaces ready to lease, and it leased just automatically overnight. So it's a very, very good market for us. And one of the reasons that we're successful, Ralph, with this market, with any market, is that we prepare spaces in advance. We don't wait for the tenant to come to us and say, well, we'd like to have a space. We want you to design a space. What we do instead is that we prepare the spaces in advance, under 2,500 feet, that are good for tenants of 15, 2,000, 2,500 feet, that go and take a look at it, they like it, and they sign a lease. It's a very effective way to do marketing, very effective way to lease properties, and we love that market because the properties just lease almost automatically.
What do you think of co-working, which WeWork came along a few years ago, and they really struck it rich. Everybody talked about it. And, I mean, how would some of what you're doing compare to, what WeWork ended up doing for a while?
So,
they're
yes.
still there. They're very, still. Talk about WeWork.
What we're doing, Ralph, is related to that. We have something called Biz Suites, and we've got 9 different locations for Biz Suites, and they are more along the lines of traditional executive suites. We don't provide a lot of services, but they lease one and 2 offices at a time, and they are very popular. They lease up just almost automatically, and that's another aspect of leasing to the smaller tenants. Is that that's one area of it's been very strong for us.
Is there something maybe that you know you look, you find Class B properties, and you make improvements in many cases, like a place with no air conditioning, really, or a funky air conditioner, and you fix them and do it. What about? What's your kind of a guideline in terms of overdoing it? You don't want to like go Cadillac where it's not a Cadillac market. Tell me a little bit about some of your philosophy there on doing just enough, but not overblown.
Yes, yes. Dave, maybe you can speak to that a little bit about how we acquire and how we improve.
Yeah. Ralph, it's a good question because you hear about flight to quality in the A space, and that's all about the larger corporate tenants and catering to those tenants who are willing to pay the highest rents, go into the most expensive spaces. What we see in the B space is a flight to value. So we're actively seeking all these B opportunities. We're looking for the ones with good access. We're looking for the ones with good visibility. And we're looking for the ones where we can put in the right amenity package so those tenants receive value. It's a move-in ready suite. It's at a reasonable cost. It might be a third of what they're going to pay to go into an A project. So these small to medium-sized tenants are really attracted by these move-in ready suites. But we're sourcing everything that comes available on the market to make sure we focus in on the few that really fit the profile of what we're trying to achieve. And the other thing I would take, Ralph, is it is important to buy it right, buy it at the right price, establish a favorable basis that allows you to provide not only rents to the tenants at a favorable price, but it returns to your investors. We're looking for other key things with those properties in terms of catering to the users. So when you establish that low basis, you can offer rents that are roughly a third of what these A tenants are paying for the highest quality spaces today. The question is, if you're a corporate user, you might be willing to pay $60 a square foot in occupancy costs. But if you're a small user, you're a startup business, you're a small professional firm, you might be looking for that $20 rent or a $20 all-in occupancy cost or something around that number.
What about the length of a lease with some of the flight to value people? I love that. That's a good one. I'm going to remember that, flight to value. That's great. But what about the people, the smaller companies, the startups? What the term of their lease? How long do they particularly say? When you say, hey, we can do a 7-year or something, do they say, no, let's do for, talk to me about that term issue.
So Ralph, that is typically 3 to 5. It's for most of our tenants, it's 3 to 5. And we are very focused on turnover. Turnover is almost the number one issue in our company right now. And I just got out of a call this morning with the management department, and our turnover rate historically has been quite high, like 60, 70%. Very high turnover with the kind of tenants you're describing. However, because we're so focused on it, and because we're careful about who we put in the space, and because we are focused on giving white glove service to these tenants, that we're getting them to stay. And our turnover rate now is down to like 30, 40%. So we've really turned the corner dramatically. We keep most of our tenants now, which is really important. Sometimes a tenant will move out of the area. Sometimes they'll go out of business. Sometimes they'll merge with another company, but you can't avoid all turnover. But we try to keep the tenant we have, as one of our tagline is, keep the tenant you have, it's sacred. The other thing, Ralph, that I wanted to describe to you is that there is something called the NPS survey. Have you ever heard of the NPS survey?
I think I stumbled across that when I was reading some of your material recently. Net
Promoter Score. And what that means is that you ask the tenant 2 questions. Would you promote, how are we doing, and would you be a promoter of ours? And they respond, and we are very active in getting the solicitation of these tenants to vote. And we do this twice a year. And our numbers have gone from, out of 100, our numbers have gone from in the 30s up to gradually 40, 50. Our last number, last 6 months, was 69.3. And when you hit 70, you are considered world class. So there's very few companies that are world-class. Ritz-Carlton, for example, is 72. And so we're doing another survey the next couple of months. We expect to get into the world-class category. And there's 17 commercial real estate companies nationwide that do the NPS score like we do. And we are far in excess of any of our competitors. I think number 2 might be in the 50s or 40s or something like that. And they go all the way down these national brands. I could tell you the name of a national brand, but I don't want to get sued. But there's a national brand that you and I know very well that's -10, right? There's a leader in the industry, they're -10. And so, but by us being 69.3, the tenants love us. We provide this white glove service, and they tend to stay with us. Brands that you know, like Apple and Honda, for example, well-known brands, well thought of brands, are in the 50s. Okay, we're up in the 69.3 and moving up. So we're in very rare territory right now.
That's great. I'm sure keeping the tenants and not having to, do anything, radical redo of the space or whatever, rebuild it for the next guy and all that. You're avoiding a lot of costs there, I would guess. What about I know you're strong in Houston, but what about San Antonio? I know you have quite a few properties there, and I just seen something just yesterday about number 1 population growth city in the nation is for the last year has been San Antonio.
It's a CoStar report. Yeah,
that's amazing.
It is amazing.
That's a good place to own property, I guess. And you do. You own buildings there.
You want to speak to
Yeah,
that?
it's been a tremendous performer for us, Ralph. We, I think the first shopping center was acquired there in the early 2000s, around 2003. And we were a little reluctant to expand to the office market there because the perception was we really need to be in metropolitan areas as deep as Houston or Dallas-Fort Worth. But about 7 or 8 years ago, we decided to go ahead and expand into the office market as well and have not only bought retail properties, but office properties. And what you'll see is a market like San Antonio continues to grow. The population continues to grow, but it doesn't seem to get the developer and investor pressure that many of the major markets do. And therefore, there's been very little supply added as this market continues to perform and grow. And rents have been very stable and growing there. It's been an excellent market for us from an investment standpoint. We've really performed well there. We've got 10%, essentially 10% of our net operating income coming from San Antonio. It's been an excellent market. Glad we're there. Wish we owned more. Great market.
Yeah, I think that same survey mentioned New Braunfels, which is maybe 40 miles or something north of San Antonio, between San Antonio and Austin. They also, New Braunfels, has had tremendous population growth in the last year. You could buy something there, man.
We love to buy in Austin. Unfortunately, if we looked in Austin, we look all the time in Austin, but we're priced out of the market.
Yeah, price is like a high barrier market.
Oh, it's hyper right now.
Yeah.
It's amazing how many announcements, big buildings, and residential towers and office towers. I think Tesla going there just dumped a ton of gasoline on that market. It is on fire. It's pretty amazing. Those houses, I saw a stat, something like the homes in Austin, there was like 1,500 of them that sold 100,000 or above the asking price, the original asking price they put on the market. It's just gone crazy in every sector up there. And I know you're also big in Big D, Dallas. Talk to me a little bit about that market.
Dallas-Fort Worth has been a key expansion market for us since 2003. We've now got 40% of our net operating income coming from there. Significant presence in the suburban office market, 4 really high quality neighborhood infill shopping centers, and then a little bit of flex property there. But it's been a tremendous market for us for expansion. I think Dallas-Fort Worth received the most real estate capital last year out of all the metropolitan areas across the United States. So it's getting more attention now than it has in a long period of time. So what we're seeing is there not quite as many investment opportunities there just because it's getting the level of attention it is. So we're seeing a few better buying opportunities perhaps in Houston momentarily. But what you'll notice if you follow the trends over time, we see the opportunities move around from metropolitan to metropolitan area. We're somewhat location agnostic where we have a presence. So the capital is going to go and our execution is going to go where the best opportunities are.
Yeah, well, I believe if this is still the case, but I think at one time you had a board member, Gerald Haddock, that was.
He's in Fort Worth, yeah. Former executive with Crescent Real Estate, yeah.
He's a big. He's and he knows he was there with Rainwater and those guys.
That's right.
Big in Fort Worth. Yeah. Tell him I said hi. I haven't seen him in a long time, but I think he, I used to, when they had so much here, he was in charge of Crescent and the Woodlands and Greenway Plaza, and I would hassle him all the time with questions, so but he's been a few years. Dallas is good. What about, speaking of other markets, I think this is accurate that everything you have is in the Lone Star State of Texas. Any thoughts about, going to other places?
Over time, we've explored other major metros, Phoenix, Denver, Atlanta, Tampa, Orlando, Nashville, and we've really made the decision to stay Texas focused and perhaps expand regionally. A key for us is we see enough investment opportunities in the markets that we're in and the other markets within this region. And the other thing to think about is operational expertise, because when we buy these B assets, we're not using external resources to turn them around. We've got the property management team, we've got the leasing team, we've got the construction team, we've got the in-house firepower. So we need to have a critical mass wherever we go to make sure we can execute on the turnaround.
Yeah, that you get spread out, and of course, you go to Atlanta and you only have one property. That's property management would be an issue if you're going to, unless you outsourced it or something. But it's not off the table. It's not dead. Going to another state is.
It's possible downstream. We don't have the expectations to do it anytime soon.
We probably see more in Oklahoma than any state.
Yeah.
Louisiana, not so much, but Oklahoma, quite a bit.
Regionally, Al's right. Regionally, we see more in Tulsa, Oklahoma City than anything else outside the markets that we're in and looking at in Texas.
Do you think we will, see more? Some people say recession is around the corner if we don't turn this around nationally. Is there going to be a chance for another round of foreclosures coming through the pipeline?
That's possible. We find that almost in any market, there will be distressed operators or funds that are at the end of their life that are really motivated to let things go. So we do see a few foreclosures, a few loan sales on an ongoing basis. That already exists in the market. It could pick up a little bit as we move forward. We definitely keep an eye out for those things. So.
Yeah, I think it will hurt the marginal operator that's just got a property here and there, and he may be at the end of his rope and has no more capital, and a little recession might hurt him. Whereas with us, we thrive on recessions. We've really come on strong during recessions because we're very competitive and we still win the business and fill our properties.
That's right. Really, you're kind of there. The suburban office market, is that's with all the work from home thing and all that those issues. I would think that's probably pretty good for your company.
It is, Ralph. I had a board meeting yesterday And one of the investors asked the question about work from home. Doesn't that have a negative impact? And I was explaining about we've done a tremendous amount of research and study on that impact. We did that a year and a half ago, maybe 2 years ago when COVID hit, to find out really the true story. And the real story is that when people are working from home, they are isolated, they get depressed, and they are not able to collaborate with their team members, and their health declines. So there's all kinds of reasons why, and their productivity drops. Productivity drops like 30%. It's a big issue. And so if you're a new employee going to work for a company, how do you get promoted? How do you interact with other people? How do you talk to people and learn from other people? When you're at the water cooler, walking down the hallway, I mean, it takes all these touch points for somebody that's new to grow in the organization, to learn the organization. It's much better, especially if the new generation coming up, it's much better for them to be in the office. Some of the people that are our age don't mind working from home and closing out their careers from home, but the young people really need to be in the office. And I think the millennials and down represent like 50% of the workforce right now. So so we see that coming back with a vengeance. I mean, people have tried it. We see a few people that have moved out. We've lost some people. But on the other hand, there's more people that have tried it and don't like it and want to come back into the office.
Yeah, I would only add to that by saying that's been a significantly greater impact in the A space, where you have corporate America being driven by, at first, the legal department and the risks associated with coming back, and then the HR department trying to be sensitive to the workforce. But when in the small to medium-sized users, those folks were very decisive early on. They started making decisions to upsize, downsize, move, whatever they were going to do. So they've already jumped into the market, and they've started pursuing opportunities a year and a half ago. They were early to come back to the office, and they weren't waiting on the HR or legal department to tell them it was okay to come back or to make them come back. They moved quickly.
Well, the Wall Street Journal did a piece about this yesterday by Conrad Putziak, one of the writers there. You can talk to Richard Florida from the University of Toronto, and the big thing, I think one of the big complaints is for these folks why they don't want to come back to at least to New York is the commute. They just if you have to ride a train or subway in New York, of course, that's public safety there is been found lacking, and to say the least. And but also, just that huge commute. That's a big hurdle in a lot of places. And I'm thinking, well, if people don't want to go to these downtowns, that would be good for the suburban office market where you guys are.
No question. The mass transit conversion from mass transit to commuter, the move from those urban dense cities, Manhattan to Texas cities that have a lot of active suburban life, has been very helpful to the state and to us. But it's true. A lot of folks want to be close to home. They want a short commute to a suburban office building, and that's very much true.
What Ralph described is a trend. The downtown is suffering. Even now, I think the downtowns are suffering, and we're booming.
It's part of de-densification. Yeah.
Yeah, I guess it go either way. Maybe it will lead to some office or some residential being built more residential in downtown, with a hope to make people don't have to commute. But I think it also could be employers, having satellite offices or something. The whole commute issue is a big one, and now with the employment situation, it's so hard to get employees and keep them. Mm-hmm. That we think that some change is going to happen, and it's going to keep on happening pretty well.
Yeah, I can see why they have a hard time in New York and Chicago and California. People are moving here in droves, Ralph, you know the data better than I do, but we're getting a tremendous number of people moving from out of state because they're fed up with the regulations and the whatever, the safety, public safety you mentioned, and a variety of other things, taxes and other things.
What about your employees, Al? With the work from home thing, what's your policy on that? Have you?
Well, it's interesting. We did change. We went through a big change through COVID. We became a lot more flexible in allowing people to work from home. Some people work, 2 days from home, 3 days in the office. And it's even allowed us to not have to expand our home office because we have that flexibility built in. But we became a lot more flexible in terms of allowing the tenant a little bit more autonomy in what they wanted to do. And it's worked out very well. And but still, you still need to have people in the office to be in the company-wide meetings and all the other variety of meetings we have weekly that just people need to be together. So, but I would say we've maybe got maybe possibly 25% that have a flexible schedule like that.
Yeah, and I could see what you said when you pointed out, like, how would you like to be a recent grad and this is your first job, and getting plugged into a company, learn the culture, finding a mentor or just a colleague that you can ask their advice. What do you think about that? Or how are we supposed to, all that when you only know people, through Zoom, and that would be really, really tough for a young person breaking into the workforce.
Yeah, you hit the nail on the head. The onboarding is a big process. We put a lot of time and effort into onboarding, into mentorship, to be able to get them on a track that they, because we focus on employee turnover also. You'd mentioned the shortage of workers. So we're really focused on, keeping the employees, the team members that we have. And that's a good way to get them plugged in, is when you get them oriented and get them in the office.
Yeah. What else about, can you, just a little forecast perhaps, or maybe some about Houston? We still got we still got some trouble sectors, and we still got, you would think that oil would be doing better. How can it not be better when you're back at these kind of prices? It almost hit 120 yesterday, I think. So it's 120 a barrel. But what do you see for the Houston economy as a whole?
Yeah, I'm really encouraged. If I had a chance to tour a number of our office properties, suburban office properties last week, and it was tremendous because the leasing agents were on site talking with us about their leasing activity in our properties. Much of that is in the move-in ready suites, but you could tell velocity is as high now as it's ever been in the company. We did almost 1 million square feet of leasing last year. Significant portion of that was here in Houston. A lot of that was in the energy corridor. So it's about having the right assets deployed, at the right time in the right way. And if you do that, you're going to stay in front of the businesses that are expanding, relocating, and moving, and you're going to cater to them, and you're going to capture your fair share, if not substantially more than your fair share of the market, and move the needle dramatically on occupancy. So we follow a number of folks. We follow the Dallas Fed. We follow the Greater Houston Partnership, what they're putting out in terms of employment data, job growth, employment growth. The trends are all positive for Houston. It's really very encouraging, and we think that's going to continue. If you remember, Ralph, Houston was kind of the last MSA into the great financial crisis and the first one out. If there's a slowdown coming, that could easily happen again. It could easily happen. It could go in growing, come out almost immediately. So.
Well, yeah. Don't you guys agree that a recession's in the cards for our nation?
I think the odds are there that it could happen, but not that it's a given. I think a slowdown is inevitable, but not necessarily a recession. these are odd times economically nationwide. So there's no playbook for coming out of a pandemic where the Fed and the federal government have put out 10 trillion in stimulus, and we've got to figure out what it looks like when we're trying to open these supply chains still. But I think we're going to be in really good shape on an ongoing basis here in Texas. I feel really good about that, and definitely feel good about the Houston economy.
By the way, I've got a couple of things, Ralph. One is that to Dave's point about the leasing activity, we were designated by CoStar as being the #1 group for leasing last year in Houston, and we think that applies statewide. We don't have that measurement, but we certainly are #1 in Houston. And then also regarding the economy, we are locking into interest rates right now. We're a little late, but we're locking into about 4.5, 4.75, below 5, sub 5. We're getting ready to lock on that the next couple of weeks, and to refinance our whole company. So we're locking into interest rates right now for a 10-year duration for the most part, because of the board is very, very strong on this. They don't want to play the markets. We don't know what's going to happen with the market. I tend to be a little bit pessimistic, because like Dave said, the money supply has increased 20, 30%. They're spending money like drunken sailors. We don't have responsible people in control, and it could create a big problem for this country going forward. And so we've got to get that situation straightened out in DC, because it's basically a dysfunctional situation we have going on. It's really a travesty. It's really tragic what's happening. I think this country is being destroyed from the inside, but that's my opinion.
Yeah, let me elaborate a little bit on the refinance and our debt structure. The debt is ubiquitous in the acquisition of commercial real estate. But the key thing to think about with us is the goal is to keep leverage at 50%. We're often competing against local and regional investors who are using 65, 70% leverage. So it's painful for everybody when rates go up, but it puts us in a stronger competitive position because we don't use leverage as much as our competitors do. So
that's when rates go up, that's where you want to be.
Right.
As rates go up, that will help. I mean, and then we didn't talk about inflation. So inflation is going to help hard assets. We know that. So if you have your rates locked, then your equity comes in and gets the benefit of the rising value of the properties, the assets. Ultimately, the rents have to go up because other things are going up. We're paying more for construction materials. We have supply chain issues with construction materials. There's delays. In Dallas, we wait as long as 6 months, I think, to get a space built. I mean, it takes a long time. We've had a couple of tenants that have wanted to move out of our building, move to another building, but they had to delay it 6 months because they couldn't get the space built. And it's really, but ultimately, it's got to be passed to the consumer and to the tenant. The inflation, because the landlord is not going to bear the responsibility. They're going to pass it on.
Inflation, I think that's one of the traditional hedges. You go to real estate, and that's when inflation's heavy. That's where you can go and stay afloat and keep up with things rather than watching your money shrink every day.
So in a recession, in a bad economy, you have buying opportunities, and with distressed assets or opportunistic opportunities, and then you lease them up and increase the value because the market itself is moving up. That's kind of our outlook for the opportunity.
And for Al, for young guys that or watch what you do, and they're 28, 29 now, and they want to, they want to do like you. Follow in your footsteps. What advice would you give them in 2022?
Well, the way I started buying. I bought a house, and I bought a duplex, and I bought 16-unit apartment building. I mean, you can buy. There are assets like that you can buy, and there's organizations like Lifestyles of America that help facilitate buying those kind of things. They're a tenant of ours in one of our buildings, but they put groups together, small groups together, and you can bring in investors, you can bring in a group and buy properties together. And so there's different opportunities like that in real estate, or to work for a company like ours. If there's somebody out there that's 28, 29 years old, wants to work in commercial real estate, we'll hire them. So we're hiring all the time. So it's a great question, Ralph. The barriers are not any higher right now. There's still opportunities available for all comers.
Al Hartman and David Wheeler with Hartman REITs, based in Houston. Thank you very much for your time, and we enjoyed talking with you very much. Hopefully we can do this again sometime. Just really enjoyed our discussion today. So.
Well, thank you, Ralph. I appreciate you very much. You're an icon in the industry, Ralph. I think you're better known than anybody, and you do a great amount of publishing of good information, and I appreciate it. I read your report every week. It's an excellent report. Keep up the good work, and thank you for supporting the industry very much. God bless you, and have a good day.
Thank you, Ralph.
Thank you, Al. Thank you, David.
Okay. Thank you. God bless.